Hey everybody, welcome back to the channel. Okay, Palantir, high growth tech stocks, and to be honest, pretty much every other stock in the market, especially the S&P 500, which tracks all the 500 top most companies in the market, are going down today. They are crashing extremely badly today. I mean, this stuff is carnage in the market. We're talking blood is out there. Palantir in particular got down to around 1530s, I think, at the low today. By the way, for those who are curious, I did purchase Palantir, about $1,500 worth of it at around $15.92. And currently it's at $16.48 at the time of this video. So we had a pretty nice bounce. But to be honest, I think it's just, I have faith that it's probably just going to go back down given the way the market is reacting. I mean, maybe it keeps rallying and keeps going up, but then the general market would have to match that concern. But at this point, to me, these prices are absolutely insane. And I potentially see it coming back down, especially if the rate increases start scaring more and more investors. They're going to be selling off this type of stock. But I did make that purchase at about $15.92 today. So today we're going to talk about why this is happening. There's a bunch of key variables that are going on ultimately to propel and accelerate some of the carnage and blood we're seeing in the market. What's the main reason for it? So the first thing that's important to note today is that the 10-year Treasury Bond just hit its not all-time highs, but highs that we haven't seen in the past year at 1.8%. Now, for those who don't know what that is, I'm going to read the proper definition right now. A 10-year Treasury is a bond that guarantees interest plus repayment of the borrowed money in a decade. The 10-year Treasury is just one of a handful of securities issued by the U.S. government. So for those who don't know what bonds are, basically they're these like IOUs that are offered by the U.S. federal government. The U.S. federal government issues them, and there is a set level of interest that they pay on those bonds. So they get to have your money, and they get to do whatever they want with your money. And they guarantee that in 10 years, they will repay you back plus a level of interest that they're giving you on your money. Now, higher the interest, obviously, the more attractive the bond is. The problem is when stocks are really high and when stocks are giving you an average rate of return of like 27% in the S&P 500 over the past year, you don't invest in bonds, because why would you invest in bonds if you're getting way more return on your money in stocks? When stocks go down, it becomes much more volatile and much more riskier to get a return on stocks because you don't know how the U.S. market is going to perform, but you always know that the bond is going to be safe. That's why the interest rate is usually much more lower, because you can always trust the government is going to be able to pay you back your money, because the government really does have unlimited amounts of money. So you would rather put your money into a bond if stocks aren't doing well, because you are going to at least get a guaranteed rate of return of whatever percentage it is, usually around 1.2, 1.3%, and now, as of today, it's about 1.78%. This means that when bond rates go up, stock prices go down. And when bond rates go up to the prices that we've seen in the past couple of days, or at least today, stocks really get hammered hard by this, because more and more investors, especially institutional investors, are like, why are we putting our money here when we can put it there and we can get a lot more money putting it there? Now, this has mainly been influenced by rate hikes. We talked about inflation a lot on this channel. Again, when the Fed raises interest rates, they're trying to combat inflation. They're trying to get less money into the economy and get all the money that's been artificially pumped into the economy over the past year to start getting out of the money. They're trying to get people to stop spending, trying to get people to stop buying, because less dollars that go into the economy, the better it is to combat inflation. Interest rates are really, really scaring a lot of investors. It's almost like you would think that the price is starting to get baked into a lot of these stocks, that, okay, rates are going to rise. We know that they're going to rise. The Fed has said they're probably going to rise them about 4 times this year. And we haven't risen them really for the past 2 years because of the coronavirus pandemic. But investors are still scared about that, because they feel that when rates rise, there's going to be a really even bigger massive sell-off, which is why they're selling off before that happens, trying to protect themselves from the downside risk and putting their money into bonds, because you got to put your money somewhere, right? You don't want it to have cash, because if we don't solve inflation, then you're literally losing money if you're sitting on your cash. So the rate hikes and the interest rates are leading towards the 10-year to go to new highs that we haven't seen in a while. And the S&P is selling off. And this is what I really, really, really want to analyze today. So the S&P 500, for those people who don't know, it's an index, it's an ETF that you can buy on the markets, and it tracks a lot of the, or tracks the 500 biggest companies in the world. And there are certain parameters for how you can get into the S&P 500. There's a lot of like different metrics. And then ultimately, once you get added to the S&P 500, every portfolio manager that runs an ETF has to have a little bit of exposure to your company, because if your company is in the S&P 500, your company is one of the better companies that exist. So it's good to be in the S&P 500, because more and more portfolio managers want to buy your stock, because your stock is in this index that is really one of the biggest indexes in the entire world. Couple of really interesting stats that are important to talk about. The S&P has not had a 5% decline, meaning a 5% correction from whatever price that it was at in the past 14 months. That's over a year. We haven't had a 5% pullback. That means if it went down 4.9%, it would bounce right back up and then keep going further and further. For the past 19 months, it has not touched its 200 moving day average. This means that the S&P 500, in the midst of a global pandemic over the past 21 months, has just been going up and up and up and up. And it doesn't make any sense because when we're having a global pandemic, when people are losing their jobs, when a lot of companies are getting decimated, when there's massive amounts of labor problems, supply chain issues, which are then causing inflation issues, the index that measures most of the top 500 companies in the world shouldn't be going up. But it did go up. And the reason it did go up is because we put $5 trillion of stimulus into the economy. Whether that's good or bad, that's a more political question. But from an economic perspective, there were moments in which maybe we didn't need to put that much money, but there were also moments in which maybe we needed to put a lot more money. The Fed also increased their balance sheets, which meant more and more money kept going into the economy. Now they're starting to decrease their balance sheets because they're starting to taper a bit, which means that the S&P, someone could argue, would be a little bit more artificially pumped, which is why we're seeing a little bit of the sell-off. Now, part of the sell-off is because 30% of the S&P is in technology companies. So energy stocks should be doing well. Financial stocks should be doing well because these are the stocks that typically tend to do well, even if the broader tech stocks are starting to decline. The problem is the S&P, 30% of it is in these high growth, really, or even large cap technology companies. And what happens when interest rates go up? Technology companies start to go down because the cost of borrowing money becomes higher. Inflation and interest rates are not good for companies that don't really have free cash flows, don't really have profits because they're trying to just gain market share. The hope is on future cash flows because you're going to have exponential growth. But that hope is very risky, so investors don't want to bet on that risk, which is why they sell off those stocks when interest rates go up and the economy starts to decline and not be as much of in a bull run. That's why the S&P is also starting to correct. And it's very likely that it's due for a 10% correction. I mean, the S&P going up this much over the past 2 years, like 27% rate of return. The average, I think, S&P rate of return per year is supposed to be like 8 or 9 or even 10%. Like there's obviously been years where it's had really good years in double digits, but it's not like 27 it's not supposed to be 27. That's a lot, right? And because that's happened in the midst of a pandemic, we're starting to see a sell-off, which it might be due for a 10% sell-off at this point. On top of stocks falling, Bitcoin and crypto is also going down because they're having a similar reaction to how stocks are reacting in general from a macroeconomic play because the entire market is starting to correct itself. So Bitcoin and crypto is starting to have a little bit of a correction of itself. Cases of Omicron are reaching its peak in New York City. And that's good because if it's reaching a peak, then it's likely going to start to falter down. But that does mean that there are still some issues going on with Omicron and the COVID pandemic, which is also scaring off investors. And then inflation and supply chain issues are still becoming an issue because of labor shortages. So the unemployment rate just came out that it's record low unemployment rates at 3.9%. The problem is there are still many jobs that need to be filled. So it is easy to get a job, but we don't have that many people that want to work, or there's other dynamics for why people don't want to go back to work, which means businesses are suffering because if you don't have people to do work, then you don't have products and services to sell, which means the entire processes of a business, and we're not talking about like a huge business, we're talking about a mom and pop store, a restaurant, a movie theater, etc. They start to fall apart and become less efficient, which hurts the macro level economy as well. And investors, as a result, sell off and put their money into something more stable, which is the 10-year Treasury yield. The market ended up recovering a bit. The NASDAQ 100 erased a plunge of about 2.7% to end the day in positive territory. So, we're seeing what we're seeing happen in the market right now. This is getting to my analysis now. Is that there are so many fears of what's going on with inflation, so many fears of what's going to go on with interest rates, and so many fears of if these tech companies are actually good technology companies or are we in a dot-com bubble? And I'm doing a whole nother video actually comparing the tech companies of today to the tech companies of the dot-com bubble. That investors are starting to feel really scared about it. And because they're starting to feel really scared, they're trying to put their money into someplace that is better. For me, and sort of my way of approaching this market is I'm continuing to buy the dip. It is the strategy that I'm using now. Will I always use that strategy in these certain types of conditions? Probably not. However, I am conservatively buying the dip, meaning, I had a lot more money than $1,500 today to spend on Palantir, but I chose to not do that, right? Because even when I got to 1540s, I bought at 1590. I was like, well, if this blood keeps happening, we might see 14, right? There's no reason we couldn't. There's not, an arbitrary rule that it has to stop at 1540, and then we saw the bounce up. That's where timing the market gets hard. So, if I didn't buy at 1590 and I was waiting for it to go to 1540, and then I saw it go to 1530, which I think it did, I'd be like, oh, well, it's definitely going to go to 15, so I should wait. And then I would have never made the purchase, and then it runs up to 16, and then I'm chasing it at 16. That's why you kind of just got to make the purchase and buy when it's time to buy. But it is very interesting to see what is happening. I am choosing to buy the dip because I do believe a lot of this stuff is overblown. Omicron's going to start to go away. Supply chain issues are really starting to clear up. If you're actually looking at the data, we're importing a lot more stuff. Inflation to me is also going to start to go away because the Fed is going to raise interest rates, and I think consumer demand is coming down. We're also getting new consumer demand reports coming out on Friday, so we're going to be able to analyze those. So I think the macro level economic conditions are going to start to shift in the favor of money going into value stocks transitioning back into growth once those things start to decline. But I do think there still may be some more blood that is ready to be eaten up, at least over the next 6 months as the Fed increases its interest rates, if investors are scared. Now, if investors stop being scared and they start recognizing some of the potential of what they're actually investing in and recognize that macro level conditions are not as bad as it seems, and that there are better things on the horizon, particularly with labor shortages, supply chain, and inflation issues, then there is a chance that investors really start buying the dip, loading the dip in particular stocks, in particular indexes, and that we do see a bounce. I just think because we've seen such a great run over the past 2 years, there is a world in which it's time for the S&P to correct. It's time for some of these other stocks to correct. And when that's happening, you just got to sit there and let it happen and continue to dollar cost average your position and then wait till it ultimately gets better. So those are my thoughts on what's happening in the market today. Let me know what you guys did. Let me know any moves you guys made in the market, and let me know your comments on how you feel the macroeconomics are playing out. It is very interesting to see how this all plays out, especially if you start to understand a little bit more about how economics work, which I'm learning more and more every day. It's really interesting to see how all this stuff is analyzed together, especially with all the events coming up this week from a political perspective that affect a lot of these financial gains and losses that people are having. So interesting stuff. Thank you guys so much for watching and listening. I will see you guys in the next one.